Hi, David Moore with Equity Advantage, 1031exchange.com, and I've got Greg Genovese with USG Realty Capital. Yes. So we've talked about a lot of different things, sort of broad-stroked it, but bottom line, OZ, QOZ, what do people need to know? I mean, as far as the process, if somebody's interested in it, I was reading something about the process a couple days ago, and somebody says, well, gee, I own property in this zone, so do I get this? Or what do I have to do to make it fit? Can I just go buy it and do what I want and have it qualify? Or if I've got a situation where we're going to talk about a couple different things, since I'm in the 1031 business, it's all about me, right? But if somebody weren't to complete one of my transactions, how do they get in? We talk about a fallback. You sort of said it's B, but what does that mean, and how do we get into something? Let's say that Tacoma project, when it's done, how do I get involved with that? Does it have to be done for me to get involved with it?
Yeah, certainly. And actually, you brought up a few good points. Let me take them kind of one at a time if I can. And it's interesting that you said, and had you not said this, I probably would have forgotten to bring it up to your audience. You said, hey, I've got a client who called me and said, hey, I bought some opportunity zone land. So let me make sure I'm looking right at the camera to your people here. The way the initiative reads from the Treasury Department, you really need to be careful. You need to invest into a opportunity zone fund. They're called QOFs, Qualified Opportunity Funds. It isn't buying the land. So and it's kind of unfortunate, I've dealt with a lot of investors who have done just what you said. Hey, Greg, I bought this land. And believe it or not, you talk in your business about a blown exchange.
Yes.
They blew their opportunity zone benefits because it has to be in a fund itself.
Yes.
Now, something that a lot of really smart, high net worth investors have done, which I completely promote, is they've gone to experts like yourself or some of their attorneys, and they've started their own opportunity zone fund. So you could actually, if you're a high net worth investor, you could actually take your gains, start up your own opportunity zone fund, put the money inside that fund. Now it actually gives you a little bit more leeway about where you're going to put the money, because what I'll explain in a minute is you have 180 days to invest the money from the day that you get your gains. You only have 180, just like on a 1031 exchange. By having it in your own fund, you can go past that so long as you have a business plan, et cetera. But just like anything, you get the good and the bad. The good is you've got more time. Mm-hmm. The negative is you either have to find an investment to put it into. Most funds don't allow your own opportunity zone fund to invest in them. Yeah. It's not because the fund doesn't want to, but the initiative doesn't allow for it. We expect it to change at some point. So what I would say to your investors that may want to start their own funds, either through you or if they want to come and visit us, we can advise them.
Just a quick comment along those lines. Yeah. You've been around the block. You know what you're doing. You've been involved with institutional real estate for decades. Do not hire a lawyer that's learning on your dime. If you're going to do this, talk to people in the business. Hire somebody that's done it before, because you don't want to be paying somebody to learn on your behalf.
Very, very true. But we're very happy to help with that kind of thing. That's not what we do as our main business, but always happy to help. So as far as how these programs work, let me just kind of give you the basics. The way an opportunity zone fund actually works, or an opportunity zone investment works, there is a timeline. You actually have 180 days to invest your capital gains. So I'm going to use a scenario, okay? David Moore.
So I'm going to interrupt you real quick. He just said something I want everybody to understand. You said they have to invest what?
Your gains.
Just the gain.
Yes. You can invest
more,
but you can invest more. It doesn't have to be gains. Only capital gains are allowed for the benefits. So if you were to just really like the project or the opportunity zone fund, and you just said, "Hey, I'm going to put $1 million into it, or 100,000,
just
whatever
like
it is."
You want to make an investment. You're free to do that.
You're free to do that. You certainly will get a good return, but you're going to owe capital gains tax on it.
But on the other hand, if you sold, let's say, $1 million property in an exchange, you had $500,000 in gain.
Yes.
the benefits would sort of pass after you spent the $500,000 in gain.
Correct.
Really, as far as
Correct.
the initial big benefits.
Correct. So let's use your scenario first,
Yeah.
since you just brought it up. Let's take two scenarios. One is selling property, okay, and you decide 1031 exchange or you're going to go into an opportunity zone. And then the second scenario, let's just say you sold any asset. Quite frankly, about half of our investors are people that are selling businesses. Dentists, doctors getting out, attorneys, people that we have one investor who just sold a coffee shop.
Yeah.
It could be any gain, selling Amazon stock. But let's take your scenario first. So, investor in Portland, Oregon, sells an investment property. They have they sell it for $3 million. They have $1.5 million in gain, $1.5 million in cost basis left.
Yeah.
So they now have a choice. And what's really neat about your services, the qualified intermediary services, are what I would always suggest people do, even if they're looking at opportunity zones, is still engage the qualified intermediary, because you can take those gains as long as you don't take constructive receipt. I know I'm telling you your business.
No, I love it. I get to sit here and listen.
But have that money. They don't take constructive receipt. The money is at the qualified intermediary. The investor now has 45 days to really dig in, work with you, work with their advisor, maybe looking at different replacement properties for the full 1031 exchange. But they also could be vetting an opportunity zone fund.
Definitely.
And during that time period, they can decide, listen, I think in this case, they've decided not to do the 1031. And they said, okay, I really can't get the returns I'm looking for right now. Well, in our scenario that we used earlier, there's $3 million that they sold it for, $1.5 million in gain. And so that money is now sitting at the qualified intermediary. They can take that money so long as it's within that 45-day period so far. And they can take that and put it into an opportunity zone investment. Now, what's going to happen in that scenario is, during that period of time, if they hold the investment for 7 years, at the end of the 7th year, they will owe taxes on the money, but they'll get a 15% discount on the capital gains tax. So for 7 years, you have to use 100% of your money, right? And then you'll owe the taxes, and it'll be a 15% step up in basis. If you hold it for 5 years, when you go to pay your taxes, you'll get a 10% step up in basis. And then as you hold for 10 years, 100% of those gains from the Opportunity Zone Fund, 100% tax-free. So I guess going...
So you've got limited deferral into the OZ, but what you make on the OZ, if held through the 10-year maturity, is tax-free.
Yes.
And so that's why I sort of look at it as like a Roth IRA, right? You're paying taxes... Roth money is just tax money growing tax-free. Traditional is pre-tax money growing tax-deferred, right? So look at people come to me, they want to do Roth conversion. They're going to pay the tax on that, but then whatever they buy with that money afterward, the fact is tax-free. And that's sort of what we're looking at here.
I think that's a good analogy. And I've never looked at, and this to me is a big point, it's not 1031 versus opportunity zone investing. I think it's 1031 or. And the nice thing is, during that 45 days, it really gives the investor complete, flexibility what to do with that money. Mm-hmm. Now, I want to make two quick points. One is, I mentioned the 7 years and the 5 years.
Yes.
One of the things that the government did was they actually put a hardline date of 2026. Well, we're in a few days. In a few days, we're going to go into 2023.
Yeah.
So if you invested into an opportunity zone in 2023, you're not going to have 7 years to get to 2026.
Yeah.
Right. So right now, that 7 year and that 15% step up in basis isn't in effect because we don't have enough time. But right now, the opportunity is 100% tax deferral during the next 3 years. Yeah. However, there is what's called the Opportunity Zone Extension Bill that is in Congress and the Senate.
Finally, a bill we want to see passed.
And it's very, very true. And it's being pushed on a bipartisan level. There's been no opposition to it. So the likelihood that it's actually going to go through is very, very high. I can't, in all honesty, be on tape saying, "Oh, it's going to," but it was. It's very high likelihood that it's going to.
But for the sake of the conversation, we are sitting here. This is December 20th, 2022.
Yes.
So we're right here during the happy hour. Neither one of us are wearing red. A little bit of green, maybe. But I want to clarify one thing real quick. We've been talking about it. It's not something where we're typically going to blend 1031 and the OZ.
No.
But I think that the OZ, for people, there's a lot of confusion out there because the OZ's got the same 180-day timeline 1031 has. I want to stress to anyone in a 1031 exchange today that there's something called 1031-G6. 1031-G6 is the rule that dictates when we can release money through an exchange. And inside the 45 days, so you can't legally receive funds until you've purchased everything you have the right to buy, which means there is no way that we can release funds for any reason other than to buy property inside the 45 days. So if you've got a 1031 started and the money's sitting here with us, or anybody in the exchange world that treats this business seriously, because the government's position on this is that if somebody's not following 1031-G6, it doesn't jeopardize just the person that wanted that money. It's the policies and procedures of the company. So there's nobody in the exchange world that's going to give you money outside 1031-G6 if they know what they're doing. So what's critical is if you want to take this path, you got to understand you're not going to get your money till after the 45th day to do it. But it's really critical that come midnight that 45th day, you're totally committed to completing the exchange, or as you said earlier, get out of it. Okay, kill it on the 45th day. Don't ID things. Our ID forms, by the way, give you the ability to identify multiple properties, but there's a little blank underneath that primary identification. And that blank is there stating that you are IDing these properties, but you have the right to buy only blank of them. The reason that's there is when 1031-G6 was really put in place and made hard that rule, and the government was going to start enforcing it, we said, look, we got to, somehow give our people the ability to ID things. Maybe if they're IDing 3 properties and they intend to buy one, as soon as they buy the one, the second and third are fallbacks. As soon as they purchase the one, any residual funds they are then entitled to receive outside the 45 days. So that's what's going to give you access to money to get into this stuff. The other thing I'm going to say is that, and we talked about earlier with FIRPTA, Foreign Investment Real Property Tax Act, a lot of times the money will come into us except for what's impounded for FIRPTA. And our wonderful government works so quickly that the money's not released until after the guy's outside the 1031. So a lot of times when we have FIRPTA funds impounded, we have our client come out of pocket that corresponding offsetting amount to complete the exchange. I would say going into Greg's product, that is what I'd recommend doing also. So if you're in an exchange, the exchange company won't give you your money. You're thinking, well, now I'm stuck because not only can't I get my money, I can't get into the OZ. Just think of it from the context of like, okay, you got $200K sitting with the accommodator, come out of pocket the 200, throw it into Greg's fund, and you're going to be fine because you do only have that 180 to get it done. Yeah,
and that's a wonderful point. So I was going to get to that where to your listeners, excuse me, to your viewers.
Our viewers.
Yeah. I was thinking back in the 70s on the, but really the 45 days really gives the investors the complete flexibility, right, between a 1031 and an opportunity zone. Yeah. So that's why I highly recommend don't take constructive receipt of your money. Make sure it goes to the qualified intermediary. Now, when you get past the 45 days, you are not kicked out of any opportunity to get into an opportunity zone. However, you have to have some money. Yeah. So like you're saying, if you can replace it, so in our example, I think we said it's 1.5 million. Maybe I should use lower numbers. Yeah. But in our example, there's 1.5 million. There's 1.5 million at Equity Advantage. And if they were to decide, let's say in day 100 that they're going to do an opportunity zone, what they could do is, let's say they weren't going to put 1.5 million into an opportunity zone, but what they did want to do is, let's say, 500,000.
Yes.
You can now take, if you have 500,000 in your bank account, put it into the opportunity zone. At the end of the 180th day, you're going to send them their 1.5 million, but only five they would owe taxes on the million.
Yeah.
But the 500,000 that was put in an opportunity zone, that would be 100% deferred.
Well,
so there really is a way. There are workable solutions past the 45th day. I'm just saying there's more flexibility.
Well, and the other thing, and you've hit it a few times, I mean, you're talking about the OZs just going to require for the benefit to invest the gain, right? So if I've got 1.5 net equity sitting in the exchange account, the entire 1.5 is probably not gain. Right,
Yeah,
I mean, a portion of it is.
Right,
so you got to sort of talk with your tax people and figure out what piece actually you want to get in or need to get into the OZ to take care of what you want.
And really, David, that's why I'm saying it's not a case of one versus the other. I just think that it's just another solution. Now, pre-inflationary period that we had about a year ago, it almost felt like there was only one choice, and it was 1031, because things were just so good. Yeah. Right, low inflation, low interest rates. But now that we're seeing increases in interest rate, it's tougher to get loans and financing. The opportunity zone side, because they're for the most part development deals, and if they're in the right places with the right returns and you're mitigating risk the right way, the return potential in opportunity zones is now beginning, at least for the time period, either at or moving by some of the 1031 exchange solutions. So I think if ever there were a time in the 5 years of opportunity zones where the choice between an opportunity zone or a 1031 has ever been equal enough to be, let's say, on the menu at the same time, it's probably right now. Yeah.
Yeah. No, I think you're right. So it's interesting in that the OZ. So when we years ago, probably 20, 25 years ago, I had a guy, big IRA, self-direct IRA promoter, came and spoke to our CCIM chapter, and he came in and he was pitching self-direct IRAs as an alternative to 1031, which obviously they're apples and oranges, and whatever somebody's position is on using IRA 401k money in real estate, that's their position. But typically the arguments against doing so are they won't hold water. But if you look at the OZ deal, when it first happened, for those of you who know me, I like cars, boats, planes, toys, right? And we used to do lots of high-end cars, and so we lost the OZ, took our cars and boats and planes, those transactions away, art too. But that is the tool, and we used to do a lot of business exchanges also. But you're still looking at like kind. You're talking about a car, rotorcraft. Those things were like kind. Where the OZ, I think, really opens up so many opportunities for people who want to get into real estate. You made a comment earlier, and I smile because you think, look at the number of TV shows on flipping properties these days.
Yeah, good point.
All these home improvement. Anybody could make money in the last few years on this stuff. I mean, how many times we hear an ad on the radio or see an ad on TV for some company promoting flips? Flipping property is not an investment, okay? It's a business, and no matter how long you hold these things, you're paying normal income tax on them regardless of what you think. And you do a few of them, you're going to figure it out. It's not the right way to go pretty quickly. I mean, you start working on the stuff. But I think you're right, because right now with respect to what you're doing, the project you've got going on, obviously you're not going to probably go into QOZ in an office development right now.
No.
But this type of assets you guys are building are things that are needed and high demand and pretty darn safe investments to make.
Very much so, and I think, and I loved your analogy about flipping homes. I'm all for that business.
Yeah.
It's not that it's a bad business. I like to use sports analogies, and it's kind of like saying, in football, it's pretty, all you need to do is you take the ball and then you get across the goal line and see how great that's all you got to do, and then you win a Super Bowl. Flipping property is the same way. It's not that it doesn't work.
Yeah.
It does, and it's a wonderful business. But everything always comes down to the corpus. How is the business run? How are you mitigating the risk? How are you getting the opportunities? Is there long-term return? So whether you're doing a 1031 exchange, whether you're doing an opportunity zone investment, whether you're buying property, whether you're buying stocks, I don't care what it is, whatever the business is. I look at everything first by the demographics, and I don't just mean the area demographics. It's the corporate structure around the area, because I look at everything from home values. So, for instance, let's use opportunity zones. At the end of the day, holding something for 10 years, you have to do strong risk mitigation modeling, okay? You can't just go to where all the bright, shiny objects. So, by the way, I am not against Austin, Texas. I love Austin, Texas. I'm there a lot. Phoenix, Arizona, love it. I'm from the Bay Area, so I go into San Jose a lot. But our own philosophy, because you have to hold these projects for 10 years, right? You can't turn them in 4 or 5 years. This is just our philosophy. Yeah. We want to purposely stay away from what I call equity rush areas for a couple of reasons. One is a lot of the values have already been burned off because the value's been pushed up. And number two, if you're in areas that actually can build out, like let's say, I'm just use Phoenix as an example. In 10 years, there's still going to be a lot of desert, right? And let's face it, the project that I build in 2023 is going to be the older project in the area in 2033. So when I go to sell that property, I'm now competing with David Moore Gardens down the street. And so I may have to put a lot of money into this project to keep the value up. So my philosophy on demographics, especially with opportunity zones, is infill areas that have better than average population growth, better than average income growth, but a lot of barriers to entry to that particular area. A great example is you told me you're from Santa Cruz. There's a wonderful area there called Saratoga and Los Gatos. And I remember the days in the 60s, or not 60s, I was born in the 60s, but I remember the 70s and 80s, early 80s when those were just little shacks. Yeah. And they're now, they're $6-7 million. Well, not because the architecture is so great in those properties, but because of the barriers to entry, there's just no...
you got geographic limitations.
Exactly.
Mountains
and so I look at opportunity zone investing the same way. You want to be in infill areas in good, strong demographics and good population growth, but also a good, strong corporate structure around it. So you mentioned our project in Tacoma. Well, Tacoma's infill, meaning there's a lot of areas that you can build. It's right next to the University of Washington, Tacoma. There are some major headquarters that are right in the area. I don't know if you've heard of Amazon and Starbucks and Costco and just some, but good, strong corporate structure around it so that over that 10 years, these are areas where the income growth is going to keep pace. And so from my perspective, that's called risk modeling or risk mitigating the investment so that like I said, getting out of the investment is as important as getting in. And so how do we maximize the value over a 10-year period of time? So right now we do, from a demographic standpoint, the asset classes that we like are the ones that are most recession resilient. But just being recession resilient in the asset class doesn't mean it's going to, again, what's really going to count is the area demographics from a population standpoint, et cetera. So we like multifamily. We still do. If you have the ability to be near student housing, kind of combine corporate with student housing is just an extra benefit.
Yeah. And you made a point of the Tacoma project. You made a point of delineating that, saying, hey, it may appear to have some of the benefits of student housing, but this is not a student housing project.
Correct. And it's just like anywhere. You could be, if you went to UCLA, you're going to be living in the Westwood area. It's not student housing, but students live there.
Yeah. So
that's an extra benefit. But medical office is another area that we like from a demographic standpoint. Storage is another good area. And then some industrial warehouse where you have a good strong tenant like an Amazon or those or Costco or whatever the case may be. But you're right. You mentioned earlier we're not going into office right now. So what I would, and I'm not, to be perfectly frank, I'm not here to pitch our deal, but I think when it comes to opportunity zone investing, we look at these investments, again, risk mitigated modeling. What's the asset class you're going to be in? Can it hold for a long period of time? And then also, what are the demographics like in the area? And how are they going to hold over a long period of time? To me, that's the key. And then lastly, from an asset management perspective, because as I mentioned to you before, at some point investors are going to say, we want your return. This all sounds great. I want my return, right? So we really believe in a strong, almost like a wealth advisor asset management model, where we're the sponsor, we raise the equity, but we represent our investors. So what we'll do is we'll co-partner with the developer for the project. We don't give them the money. We co-partner with them so that we can oversee and have accountability metrics in place so that we can control the costs. Because at the end of the day, the costs are going to dictate, the costs and the rents are going to dictate your cash flow returns and ultimately your total return.
Well, and they're invested with you that way too.
Mm-hmm.
And the other thing he just said, and this is one of the things you start looking at, one of the biggest objections to DST or institutional TIC ownership is that hold period, right? And it's typically 5 to 7 years.
Yeah.
But you made a comment, I think it's very important for people to understand. You build something, you finish it, it starts wearing out. All right, so 5 to 7, you start having things breaking typically, but your max return typically is somewhere in that range. The OZ is going to require 10 years, so you better have people involved that understand that and are keeping the assets in good stead so that when they do go full cycle, if they choose to.
And let me say this: I'm assuming that the people on your webcast and these are, a lot of them are 1031 people. So I'm speaking directly to them because I'm a 1031 person myself.
Yeah.
How many people out there, your clients, have first bought a house that they used as a rental, mm-hmm. then they went and bought a duplex. Now they own a triplex, and and how many times have they purchased something and they only found out like 3 years down the line that they had to pull all the plumbing out? I mean, I hope there's people right now that are going, yeah, that was me. Yeah. So same thing for us. We want to make sure what we're building, again, you're not going to find that in a new development where like the plumbing's bad, But my point is, you have to.
It's happened.
Yeah, right. But you have to contain the costs, and where the costs are really, what are the upfront costs? And so what's neat about the development deals these days is you can get what's called a GMP, which is a guaranteed max price contract from the contractor. So we go through great pains to make sure that we get a guaranteed max price contract from the contractor. And so if it goes over, the contractor is actually responsible. And right now with lumber and concrete pricing and things like that, we're able to put something out to our investors and say, here's the max price.
And that's critical for you to be able to do that. I didn't know that. That's really a neat deal. Because my general rule is you got to buy something, build it personally, and it's like twice as long, twice as much. Yeah, it's just the way it is.
No, we definitely we do it two ways. We contain it through the guaranteed max price with the contractor, but we also do it with our partnership with the developer. Again, we're business people. We always give any overages in our costs actually go to the developer. Yeah. So, and that's nice for our investors, but we have to give them a carrot too. If they go under budget, we let them keep that difference. So we kind of dangle that carrot. Yeah. But our investors would rather know what their number is going to be, and you base your returns on that, right? Versus trying to manage it, trying to go under, but it could just very well be over. Yeah. So what we do is we mitigate the risk to make sure that our investors know what their hardline number is going to be on the cost of a development.
Nice.
Yeah.
Nice. Well, David Moore, Equity Advantage, 1031exchange.com with Greg Genovese, USG Realty Capital. Thank you. We'll be right back.